is high around 10,396 on the Nifty. I think on the bank Nifty that will be above 22,000 obviously, but there is momentum and there are a lot of stocks doing well. Clearly financials leading it, Sonia. When financials do well, you get a sense that the market's feeling comfortable. But once again, we're starting at 6:1 advanced decline. We're starting with a gap up, it will be interesting to see if there's an entry point in this kind of a market. But Ashwani, what would be your trade, if any, on the market or on any individual stocks?
From a very intraday perspective, the market has given you that entry point, and from here you could have a fairly strong rally towards 10,375, 380. Particularly on the bank Nifty, again, we've opened 200 points higher. So when there is follow through there, the market finds it a bit easier to move up. So my sense is that for the moment right now, you should try to buy into both Nifty and bank Nifty.
Okay, well, I just wanted to add a word. The banking stocks doing very well. IDBI, Union, Bandhan, IndusInd, PNB, IOB, all of them up. Canada, up 2.5%. And I'll tell you, we missed important news which we should have put in top 10. The preferential offer rules have changed. Now, when you're buying a company in default, an acquirer is buying, you can buy in the market at the average 2-week price. Originally, the rule is, or for other companies, the rule is either the 6-month average or the 2-week average. And when a market is falling, especially in a default stock, the 6-month average is too high for the acquirer, making it 2-week average, but only for defaulting companies, which are being sold off by banks, has made restructuring very easy. And that is why you're seeing, I think, this tailwind for banks which have a lot of these kinds of assets. So, I mean, I can understand why IDBI, IndusInd, Canada, Bank of Baroda, all these have a lot of stressed assets, and restructuring them through getting the acquirer in via the stock market is that much easier. So very important move, perhaps that's showing up on the bank. So over to you, Anuj. I just wanted to put that on the table.
No, I think that's an important point that you made, Lata. So thanks a lot for that. But yes, the market's looking up. Let's thank our technical experts on that note. Then we'll, of course, come back to them. For now, the market's in a momentum and it's visible. And it'll be interesting to see if we take out yesterday's high, as I said, when we had that 3 p.m. slip yesterday. Sanjay Dutt is joining us from Quantum. Sanjay, good morning. We're talking to you after a long time. First of all, good morning. Thanks a lot for joining us. What have you made of this big momentum-driven market? I mean, there's so much momentum in so many stocks like Reliance, in the NBFCs, and the market's moving just one way up.
I think one thing is very clear, Anuj, that the US Fed and, of course, all the central bankers together, I was just reading about 80-odd central bankers worldwide have aggressively cut rates or pumped in liquidity. Just the US Fed itself has kind of put in about $3 trillion since March and taking the Fed's balance sheet to about $7 trillion today. And I think it'll go up to about 10-odd trillion once all the municipal bonds and the corporate bonds, etc., what they've announced. So it's clearly Fed has put a floor to the market. I think this has been the fastest, the most aggressive stimulus Fed action that's come ever in history. And the reason why people go back and start comparing to 1929 and the plague, etc. At that time, the systems weren't geared up, or the Fed and the governments weren't really aware of the implications. One stark difference that you can note right now is that at this point of time, or by the end of this entire $10 trillion balance sheet of the Fed, this will be double the amount of stimulus or the action by the Fed as what it was in 2008-9. So it's obviously this liquidity that comes into the system, cheap, easy money that's coming in. And it's all over with institutions, individuals, enterprises, and it obviously starts flowing into easier assets. And added to that, you've got the Robin Hoods and the zero dollars in the business right now. So it's a combination of these factors that are playing out.
Okay, got that. By the way, the market momentum is still very strong, so up about 0.5% for the Nifty. Sanjay, hi, good morning. So what are you buying now, right? Because there's so much momentum in spaces like NBFCs, pharma. Where do your preferences lie?
I think I'm very clear. I'm looking at places like, steel, because I think if we are going to talk about government action in India on infrastructure or spend or protection from the Chinese or whatever that may be, it'll benefit steel a lot. And steel hasn't really participated in the rally as much, of course, barring the GSPL kinds who participated for various other reasons. But I think there is a good move there in the metal space that's lying there. Being a contrarian, I think there's a good move that's developing in PSU banks also. We saw right now that PNB came out results over the weekend, and yesterday it was up 4%. So a clear indicator that PSU banks are not going to go down anymore, particularly the likes of Canara's, PNB's, Bank of Baroda, etc. So there is, I think, potential there. And my assessment comes from the fact that government is cognizant of the fact that we need to solve this banking issue if they want the economy to come back on the rails. So whether it's going to be a stress asset fund or a bad bank or any form of solution that will come, this time a meaningful solution will come for the sector to actually kickstart growth, because till they don't do that, and already in any case we know that banks are washed with liquidity, so they'll have no option but to start lending in the next months ahead. They already have started to quite an extent, yeah.
Okay, actually we will have Ritu Singh joining us in a bit to tell us a very important point that you're making, Sanjay. You know, the rules, SEBI has changed the rules to allow acquisition of stressed companies quickly through the stock market. These are important changes, and we will elucidate that in just a minute. So I will postpone the bank question for the moment. I want to ask you more generally, you pointed out to this great expansion of balance sheets by all central banks. You're a veteran of these cycles. You've seen them before. How do you navigate? Liquidity has to be respected but can't be trusted, as another expert told us. Do you stay in safe stocks like FMCGs, pharma, IT, or do you ride the economy proxies like banks? What would you do?
Excellent question, Lata. That's exactly where you've got to get both the arts and sciences together. That's the technical analysis, price action. What you see, you have to respect the price action, but at the same time, you've got to, be a slave of the fundamentals. So therefore, you've got to invest in stocks where your margin of safety is higher, while not wanting to miss out the rally. You watch the price action, trade it, but at the same time, do understand what you're trading. You should not be trading some of the junk that's been going up for the last 2 to 3 weeks. Trade those stocks where actually you see growth and value, and that even if you are going to get stuck at a little higher level and you see a ferocious correction coming in, you will stand protected. So, and we all know that the ultimate impact of all this liquidity the central bankers create, the expansion of their balance sheets, do not normally end well. They always have their own problems, whether in terms of this flight to gold, or there's ultimately a Japan kind of a situation. We need to understand that as while getting the macro picture, it's not necessarily that every time the central bankers, the policy makers are going to escape what they're doing right now. Growth has to start, and if growth doesn't really start on ground, which comes from manufacturing jobs, etc., then these kind of steps that have been taken by central bankers and the fiscal policy makers do land us into big trouble also 5-10 years down the line.
Okay, take that point. Now, Sanjay, I just wanted to get your thoughts on this big move that we have seen in not just Reliance, but the entire telecom pack. Reliance, we now largely consider telecom stock or digital stock, right? Bharti has moved up so much. Idea has also, in fact, trebled from the lows. Your thoughts on whether this is now becoming a bit of a crowded trade, or is this still perhaps a good investment?
It might be a crowded trade. You correctly pointed out, Anuj, and I think it probably might be a crowded trade. But I think as an investment theme, there is more juice in it. If you go around the world and compare large telecom, or in fact, why telecom? I would say digital players now, because most of them are kind of building in some kind of other platform around exactly what Jio has been doing, trying to integrate with, a lot of other apps, OTTs, etc., and those kind of situations, not just a pure carrier per se. So as you see across the world, over a period of time, when economies like ours, and we've seen that in the West also, when they go through that phase of expansion, penetration starts going up, the valuations also adjust, the prices also adjust to the entire environment. So I think exposure in telecom as an investor should be taken at the right prices. As a trading, they may be overdone, which you correctly pointed out. So therefore, you've got to get your entry points correct. But the theme, I think there's still more to go in this whole sector. And not necessarily in these 3-4 names, but obviously in some of the ancillary names also who are dealing with them, who would be probably vendors, suppliers. There are a large number of people who are giving them solutions. I think there probably you may see much higher gains as investors.
It's an important sector you're pointing out to. Sanjay, do stay on.